If you had to turn this $100 bill into $200 as fast as possible, what would you do? This is one lesson that everybody should learn before they graduate high school, and by the end of this video, you're going to know exactly how to do that. The answer that the majority of people would give is take that $100 to the roulette table and put it all on red, except it doesn't matter which seat you sit on or what time you go, you're probably going to lose that money. Rich people have figured this out though. They figured out the game of how they can double their money as quick as possible, which is how they're able to compound their wealth, and it's all because they understand this one concept of compounding your money with growing contributions. If you can understand that idea of compounding your money with growing contributions, you will know how to double your money, triple your money, quadruple your money. If you put your $100 into your savings account in the bank, you might be able to get a 1% return on your money if you're lucky, and it's going to take you 72 years to double your money. If now you take your money and you passively invest it into the stock market, you can expect to get a 7% return on your money over the long term. That doesn't mean you're going to get 7% every year. Some years are going to be more, some years are going to be less. But over the last 100 years, we've seen that you should be able to get a 7% annual return on your money, which means it will take you 10 years to double your money. Now, if you want to be a little bit more actively involved with your investments, where you don't just passively put it in the stock market, but you're looking for good companies, you're looking for good real estate investments, you're actively finding better investments, well, now you might be able to get a 10% return on your money. If you can get a 10% annual return on your money, it's going to take you 7 years to double your money. But if you can get an even better return, if you can get a 20% return on your money, well, now you can double your money every 3.8 years. And if you're wondering, but Jaspreet, where in the world am I going to get a 20% return on my money? Well, your credit card company is doing it each and every year. So if you carry credit card debt and you're paying interest on this credit card debt, you are making your credit card company rich at the expense of your future wealth. Then, if you can get a 50% return on your money, well, now you can double your money every 1.7 years. Again, you might be saying, but Jaspreet, where in the world am I going to get a 50% return on my money? Well, now if you can go out and start a business, you might be able to grow your business by 50% year over year, especially in the early stages of your business. You see a lot of startups grow by 20 to 50%, especially in the early 5, 6, 7 years of their business, because now you're able to grow, you're able to acquire more market share, and you're able to get bigger profits. But if you're able to get a 500% return on your money, well, now you can see your money double every 5 months. Again, you might be saying, Jaspreet, where in the world am I going to get a 500% return on my money? Go to the roulette table, you go to the casino, you can get a 500% return on your money, you can double your money every 5 months. However, you're probably going to lose your money. So the chances of you getting this are very low. This is where the next thing you have to understand is risk versus reward. Higher up here, you have much less risk. Down here, much higher risk. Down here, much higher reward. Up here, much lower reward. I don't recommend anybody take their hard-earned money and try to double it in the casino as a financial planning method. That is not what I'm advocating for. But what I'm saying is you have to understand higher risk comes with the potential for higher reward. Starting a business can make you extremely wealthy. It can make you a ton of money. It can make you more money than you ever imagined. But it's a ton of work. It's a ton of risk. The majority of businesses will fail. Then out of the small businesses that succeed, most of them will never make $1 million in a year. And out of those companies that make $1 million in a year, most of those will never make $1 million worth of profit a year. It is very difficult to scale a business and make it successful. However, that return potential is there. You don't have this type of return potential when you put your money in the savings account. When you put your money in your savings account, you know your $100 is going to be $100 tomorrow. It's going to be $100 in a year. It's going to be $100 in 2 years. Maybe a few extra pennies added to it. It's safe, but you're not going to get any returns. And this is where now you have to understand that risk and reward, but you also have to understand what I said just a minute ago, the compound interest with growing contributions. This is where things get really fun, and this is what rich people love doing. So I've given this example before, but let's assume that you can invest $4 a day. You start doing this from the day you turn 21, and you do this for 45 years, and you can get an average 10% return on your money, which historically has been the S&P 500 index average over the long term. This doesn't mean you get a 10% return every year, but if you put your money into the S&P 500 index 100 years ago, you would have averaged a 10% historical return. But if you do this, your $4 a day over the course of 45 years would have been just under $66,000 that you invested. But because you're able to get this 10% annual return, your money would have grown to $1.1 million. But what if now you don't just invest $4 a day, but you do growing contributions, meaning every year you contribute a little bit more than $4 a day. Every year you contribute, let's just say, an additional 5%. That means this year you're investing $4 a day. Next year, you start investing $4.20 a day. The year after that, you start investing $4.41 a day, and on and on and on, because every year you're working to get a raise, you're working to earn more income, and as you earn more income, you also invest a little bit more aggressively. Well, if you do that, and you keep the same years, you do this for 45 years, you get the same 10% annual return, well, now you're not gonna have $1.1 million, you're gonna have over $2.1 million. You just added an additional $1 million to your bottom line, to your investment portfolio, to your cash, because you started investing a little bit more aggressively. Because what happens? Inflation happens. 45 years from now, $1 million is not going to have the same buying power as it does today. But you're also not going to be earning the same amount of money. So if you can grow your investments, well, now you're going to be able to grow how much money you can have when it gets closer to your retirement age. And if you're wondering, but Jaspreet, what if I don't want to wait until I'm 70 years old to start enjoying my money? Well, I'll talk about that in just a little bit. But this is where understanding that if you can grow how much money you're investing, you can significantly increase how much money you will have. We're talking about $4 a day here. But if you can increase how much money you're investing each and every year with the income that you're making, so every time you earn more money, you invest a little bit more aggressively, well, now you're going to be able to grow your wealth. But it gets even more fun, because what happens now if you invest more money because you're earning more money, but you also invest more money because your investments are making you more money? This is where the power of compound interest really starts to come in. Albert Einstein called compound interest the eighth wonder of the world, and the reason why it's so powerful is because the people that understand it can become incredibly wealthy. But the people who don't understand it, well, you're going to be subservient to the people who understand it. Because now what you can do, not only can you grow your money, but let's assume that now your money is spitting off some cash flow because you're investing in dividend paying stocks, you're paying in rent producing real estate. Well, now you have some cash flow coming in. You got these returns, which is great, but you have cash flow, and instead of spending this money, you also throw this into here. So now instead of having a 5% annual contribution, maybe you have a 9% annual contribution, because you're working to not only increase how much money you're investing, but your investments are also throwing more money back into here. Now take a look at this. You're still investing your $4 a day right now, but every year you're working to increase your annual contribution by 5%. You do this for 45 years, you get a 10% return on your money, but assuming that you can get 4% cash flow, and you take that 4% cash flow and you put it in here, now your annual contribution is going to be growing by 9%. Now you're not going to have $1.1 million. You're not going to have $2.1 million, but you're going to have more than $4 million in your investment fund, because now you had the power of compound interest with growing contributions. This is what wealthy people are learning to master. Now the question is, what do you do to get this 10% return right here? What do you do to get this return on your money? Because time is one of the most valuable aspects, right? There's three aspects to this. There's how much money you're investing, how much time you invest for, and what type of returns that you can get. Well, this is going to depend on your income. If you have an income problem, you should be working to increase your income. Invest this money in your own education. Go and watch YouTube videos, go read books, go take classes, go get coaching, go get consulting, go do something to invest in yourself to learn how to increase your income. If you don't have the money to invest, you have to start with that. Figure out what can you do. Cut expenses, make more money so you have more money to invest. Once you do that, now, you can't change too much about where you are in your life right now. If you're 21, great. If you're 18, great. If you're 45, great. you start where you are now. If you haven't started yet, you need to start now, so you just get started. Sure, if you're older, it's going to be a little bit tougher. Doesn't mean it's impossible, but then you can make it up here. If you're older, it's going to be more important for you to earn more money, to have more money to invest, right? It's all a formula. These are the 3 different areas where you can improve. If you can't improve here, you got to work to improve here, where you can work to improve here. So if you can't improve in one place, you got to find the other place to improve. Then this is where you can also improve how you can get better returns. And this doesn't mean that you have to go out and just throw your money at the casino, but how can you strategically get better returns on your money? I'm not going to talk about this in this video, but I want to talk about this. Let's jump back to risk versus reward. Now, before I go deeper, if you do want to learn how to be a better investor and you want to stay up to date on what's happening in the financial markets, if you haven't already, I would highly recommend you join Market Briefs. Market Briefs is my free newsletter that I created, which keeps you up to date on what's happening in the financial markets, from the stock market to the real estate market to crypto to the global economy to our own economy. That way you can understand what's happening in the markets so you can make smarter decisions with your money. Market Briefs is completely free and you can read it in less than 5 minutes every morning. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. We talked about risk and reward, but there's one more aspect that I didn't talk about, which is time in the economic cycle. Now, this doesn't mean that you need to time the market, but understanding that different phases in the economic cycle are going to give you different returns. And I'll explain what that means. When I first started investing in real estate, this was after the 2008 crash. And I was very fortunate that I started investing then because I didn't know anything about investing. I just started investing in real estate because the books that I read said that wealthy people invest in real estate. I didn't know any real estate investors, but I decided to do it. And when I started investing in real estate then, for me, I thought a decent return wasn't a 7% cash flow. It wasn't a 10% cash flow. It was 20%. This is going to sound very crazy, especially in our economic cycle right now. But back then, you were able to find good homes in good areas for $50,000. And then you would be able to rent them out and make $10,000 a year of profit. That's a 20% cash on cash return on your money. And now those $50,000 homes are selling for $150,000 to $300,000. Here's another example. Again, I'm not telling you what to invest in. I'm just giving you examples. You always want to do your own due diligence and never blindly trust a random guy on YouTube. So when you had the 2020 pandemic hit, you saw the entire stock market get cut in half. Well, you have some high dividend paying ETFs. These ETFs focus in on just high dividend yields. A few examples of this are SDY, SCHD, and VYM. For a disclaimer, I do have some of my own money invested in SCHD and VYM. Well, when the stock market got cut in half, the prices of these high dividend yielding companies and ETFs were also cut in almost half. So you saw these high dividend yielding ETFs, which normally yield somewhere between 2.5% to 3%, now saw their prices cut in almost half, which in effect meant that you could buy the same cash flow for almost 50% off. And so you were almost able to come in and buy the same dividend yield and now get a 5 to almost 6% return on your money, a 5 to 6% yield, just because you can buy these ETFs for almost half off. Now, I like cash flow because cash flow is king, but this is where you need to balance the 3 aspects. You have risk, you have reward, and then you have the timing. There's always going to be opportunities, but in order for you to find these opportunities, you have to be financially educated and you have to be willing to take on risks, because anytime you see these big opportunities, everybody is running away. When the 2020 pandemic hit, people were running away from the stock market, people were selling out of the 401ks, people were scared, but it created big opportunities for people who started buying good assets. When the 2008 crash happened, people were running away from real estate, but it created good opportunities for people who were buying real estate then. When the 2000 dot-com bubble burst, people were running away from internet companies, people were selling off all of the digital tech companies, but it created huge opportunities for people who came in and bought then. So it creates opportunity if you have that financial education and you're willing to take that risk, but most people don't have it in them to do that. So then you focus in on the risk versus reward and you ignore what's happening in the economy. So you ignore what the timing is, you ignore what's happening in the economy, and when I say timing, I don't mean timing the market, but I mean looking for the opportunities, the big opportunities when they come your way. If you're not willing to do that, no big deal. Now you understand the risk versus reward. Here, you have no risk and also no reward. Here, high risk, high reward. Starting a business is very risky, but it can be extremely rewarding. The way that you can move down this list and get better returns without taking on a whole bunch of risk is through your education. Education is how you lower your risk. And how do you become educated? Well, you can read books, watch YouTube videos, take classes, get courses, get education, get coaching, get whatever, but you also got to make the mistakes. No education through somebody else teaching you can bypass the mistakes that you have to make, because you got to be willing to learn. In order to go from here to here, you're going to have to make some mistakes. Those mistakes are going to cost you money. Those mistakes are going to be painful. Those mistakes are going to make you want to rip your hair out. But that's what's going to allow you to go from this return to this return to this return. And you have to be willing to go through these mistakes if you want to get better. So how do you get better? You get started. How do you get started? By just doing it. Now you do it, you make mistakes, and then you get better. You learn, you screw up, and you make better mistakes, because now as you make mistakes, as you lose your money, you're not going to want to do it again. You're going to want to see what it was that made you lose money in the first place. And this is where a little bit of an investing 101. Don't invest more than you're willing to lose. If you're not willing to lose that money, your money that you invest has to be separate than your savings. It has to be separate than your spending money, and it's its own money. The money that you invest is a separate portion of money that's investment in you, investment in your assets, investment in your future wealth. You're gonna see dips. You're gonna see times where you lose this money, but that's how you learn, that's how you get better, and that's what's gonna allow you to get the better returns. Most people are never willing to go through that process because they never wanna look stupid. They never wanna make those mistakes. But if you're willing to look stupid, then it doesn't matter if you make a mistake, because now you can laugh at it and then you can learn how to be better. And I know it's very hard to laugh when you're losing that money, because I've been there. I have made very bad investment decisions when it comes to things in my own business. I've made very bad investment decisions when it comes to my real estate investments. I've made very bad investment decisions when it came to investing in startups. I have made very bad investment decisions when it comes to investing in the stock market. But I've also made some very good decisions. And those very good decisions have very much outweighed the bad decisions that I made. And those bad decisions were what set me up for the good decisions. So you have to be willing to make the bad decisions. That way you can make more good decisions in the future. The real wealth that most people never talk about is not through the corporate ladder, it's through climbing the wealth ladder. This is what the corporate ladder looks like for so many people. You work hard to become an associate, you get promoted to an analyst, you work hard, you become a vice president, you get promoted to a director, and if you keep working hard, one day you'll eventually